Hey everyone, in this video we're going to be going over value versus growth. Now this is going to be an educational video. If this is something you're not interested, you can definitely skip this one. This is not an analysis video, but if you're interested in learning a little more, we have a large viewer base now, and a lot of them are asking for educational videos, so I figured I'd do something more like this. If you're into these types of videos at the end, definitely let me know in the comments so I can make some more of them. Also, if you can do me a favor, smash the like button. It really helps the YouTube algorithm. And if you haven't subscribed yet, definitely subscribe. Also, if you're not aware, we are doing a giveaway. So before we get into this video, I just want to let you know we are giving away a pair of AirPods. If you haven't seen the giveaway video, just go back in my channel. Definitely check it out. Make sure you're subscribed because we are announcing the winner for this giveaway when we hit 2,000 subscribers. So definitely be ready for that. I appreciate you all. Now let's get into the details. So, the split between value investors and growth investors, in my opinion, makes no sense. Many say value investing is dead. Others think that growth investors are just hype. Let's unpack why. So first, I think it's important to understand that if you're hunting for value stocks, you're usually finding companies that don't really have much of a future. You probably won't lose much money, but you probably aren't going to gain much either. And if you're hunting for growth, you're usually finding overpriced companies that don't make much money yet, and you could make a fortune if they hit it big, but you also could lose it all if they don't work out, and then the fundamentals and valuation end up having to meet down at the bottom. Now that brings us to the point in which you don't actually want just value and you don't just want growth, but what you really want is value in growth. And that's what's important. When you invest in just a dead company, that's a waste of time. Buying companies that don't have clear paths to surpass their current valuations is a waste of time as well on the growth side. Now, even the greatest investor of all time agrees that simply just finding the best value is not actually the best investment. Now, here's a quote from that investor. So it came from Warren Buffett, in which he says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Now, Warren Buffett is the OG value investor, and he even recognizes that buying an amazing company at a good price is much better than getting the best deal you can for just an okay company. Now let's just go over an example of value not being worth it. Here's a stock, BP. Now if you just looked at its trailing priced earnings, or even better yet, its forward priced earnings, the trailing P is 9.2 and the forward P is 7.7. Immediately, you'd look at this and you'd say, wow, how cheap is BP? And this is a value trap. This is just a classic value trap. This and the dividend. You look at their dividend, you see 5.5%. You think, wow, I'm going to be making 5.5%. And even their payout ratio, they're able to afford giving you that 5.5%. It's only a 50% payout ratio. Now, here's what that value investor is missing. Well, first, they're loaded with debt. They have $77 billion in debt and only $34 billion in cash. So they don't have enough cash to pay off their debt. Second, they're declining revenue and declining earnings from 2018 through 2020, 3 years in a row. Next, they have a rising share count, so they're currently diluting shareholders. And then lastly, they're in an industry that's past is better than its future. They're in an oil industry in which the future is all about renewables. Now that basically sets this company up in this value trap where it's like, okay, it has a great value if you're just looking at today's numbers, but the future doesn't look so great. So for the investors that looked at BP as a value investment, how has it performed for them? Well, when looking at a long period of time, because that's how you should look at any investment over the last 5 years, it has significantly underperformed the market. It's down over 30%. Of course, you did get your dividends along the way, but even with those dividends, you significantly underperformed the market and I think even still lost money. Now, of course, you could have bought on dips and sold at higher prices and made money and traded it, but over the long run, the business that's being disrupted should usually not be performing well if it actually is truly getting disrupted. And even companies that are not being disrupted, but they're just in competitive spaces that are losing market share and don't have plans to basically address how to get back to growth, they're also just not worth investing in. Now on the growth side, the same thing can be said. Here's a stock, Roku. I'm sure a lot of people, who watch this channel might like this stock. But the truth is, it has incredible growth. You look at it and you just see year over year that green revenue number on the right on that chart just going up like crazy. You see their active accounts going up like crazy. And you say, wow, this is an amazing growth company. I should buy it. But the bottom line is you're being put in a growth trap now rather than a value trap. The question is, should you overpay for the current business or its future prospects? Well, it's got a trailing P of 206. It has a forward P of 1,111, so it's expected to have less earnings next year versus this year. Now, the company has a market cap of $47 billion, and in revenue in 2020, they just did $1.7 billion with net income of negative $17 million. Now, if I thought the company had something that no one else has and it's going to basically explode with growth and eventually just print tons of cash, then maybe you could justify these numbers. But I don't think that's the case for Roku. There's a lot of big competition with Amazon Fire Stick, Apple TV, Google TV, and Roku isn't producing its own content for a subscription service the way a lot of these other companies are. So they basically are in an industry where there's going to be high competition and they're not making money. So their future to me, although they might have growth, it is not value in growth. So that is what I'm looking for. I'm looking for not a value company, not just a growth company, but a company that has value in growth. So what is that? That's a company that trades at a fair price. They'll probably be more expensive than these typical high value stocks, but they're going to be less expensive than these extreme growth hype stocks. I like to see that they are growing revenue, but I also want to see that they're growing their net income. And the future needs to be brighter than its past. Those are the things I'm looking for when I'm looking for value in growth. Now, an example for this, in my opinion, could be Corsair. This is just one example. Now, they're not just growing their revenue like a typical hype growth stock, which they are growing revenue, but they are also growing their earnings. So if you look at the blue bar, it is getting higher and higher, and it was extremely high in 2020, but it's still growing in 2021. Now, you also get large growth at a cheap price, and that's where the value part comes in. So when we look at the value for Corsair, we see that it trades at basically a PE of 15, forward PE also just under 15.02 versus 15.82. Now 15 PE is obviously more expensive than that value of BP's PE of about 7 or 8, and it's more expensive by a lot. It's double the valuation you have to pay, but the growth well justifies paying that higher multiple. And it's still relatively a cheap multiple in comparison to most stocks, way, way less than those hype growth stocks like a Roku, for example. Now, many point out that Corsair has these headwinds in the future with cloud computing, and that is definitely true, but I believe they're navigating those headwinds with a clear plan to expand into other categories with their brands like Elgato into the streaming and creator categories. Now, the bottom line, it's not about Corsair, and it's not about BP, and it's not about Roku. The bottom line is just value and growth are equally important. So as an investor, we can look at every single stock available in the entire market, and we don't have to settle for something that's just good value but no growth, or just growth and no value. We have the ability to wait and pick the right stock at the right time that presents us both value and growth. Also, a common misconception is that when you're buying a value stock, you're not taking risk. And another common misconception is that when you're buying a growth stock, you are taking risk. You can find a high-risk value company and you can find low-risk growth plays. That's just a total misconception that I don't know why people think it's just a lot of risk in growth and no risk in value. You can have tons of risk in value and you could have no risk in growth. Now, thank you for watching. Please like this video if you made it to the end and you haven't liked yet. And if you're not subscribed and you liked educational content like this, definitely subscribe. Let me know what you think about it. As far as stock analysis, let me know if you want any specific stocks. We're doing a few right now, and we are working on a video going over my investment journey. I know a lot of people have asked for it. It is coming very soon. Thank you for watching.